Hi, welcome to this session. We're going to be looking at capital investment appraisal. In other words, we call it capital budgeting. Okay, so these are usually um, budgets or projects which are quite capital intensive. So you've got to dish out some very good amount of money. So it could be a plant you're setting up, it could be a new factory setup, it could be even a new product development or product that you're launching. And these things require a lot of research, a lot of investment in terms of capital outlay. So that is what I want us to be looking at in this session. So we wouldn't go deep. Like I said, normally you would want to look at more methods. But for this one, we just want to just touch on 2 or 3 methods of capital budgeting. As usual, I'll share my screen, then we would pick it up from there. So capital investment decisions, capital budgeting, capital investment appraisals. They are the same investment appraisals. They're the same thing, all right? Okay, so let's kickstart. Let's kickstart. At the end of the day, we want to understand the importance of capital investment decisions or capital budgeting or capital investment appraisals for a company. And we also want to appreciate the existence of different techniques we use. Okay, we typically want to look at the average accounting rate of return or the accounting rate of return, the payback period, and then the net present value and then the internal rate of return. There are other methods. Okay, there are other methods. So the average accounting rate of return and the payback period are what we call the non-cash discount (NCD). Okay, non-discounting non-discounting cash flow methods. Let me put it that way. So we have a discounted cash flow methods, then we have the non-discounted cash flow method. So what do we mean by a discounted cash flow? And what do we mean by a non-discounted? So simply put, the discounted methods are saying that if I have £100 today, it's not the same as £100 in 3 years to come. Because if I have £100 today and I invest it in 3 years to come, it wouldn't be 100. It may be maybe 120 or 130. You get it? The non-discounted cash flow methods are saying no, £100 today is the same as £100 in 3 years. I mean, the discounted cash flow methods make sense, right? So what he's saying is that there is a future figure. If I'm going into this project, I'm going to get some money. So there's some future money I'll get. But if you think that in 3 years you're going to raise 500,000, the reality is that 500,000 is not 500,000 today. It could be maybe 450,000 today. So reduce that future cash flow, inflow. It can be even outflow. Reduce it to see the real amount today. That's the discounted cash flow method. So the DCF methods are typically the net present value, the internal rate of return. We also got something we call the profitability index. Okay, and we also have what we call the discounted payback period. So they all fit within, but we're not going to look at the payback period. We're not going to look at the discounted payback period and then the profitability index here. We just want to stick to NPV and IRR. Whereas the ARR, the average accounting, or AARR, average accounting rate of return, sometimes is the same as the ROC, return on capital employed. Okay, but the formula is a bit different from the ratios. You know, when you're dealing with financial ratios, ROC is simply operating profit or profit before interest and tax, or sometimes earnings before interest and tax, divided by capital employed. And capital employed typically deals with what? Our long-term liabilities plus the equity. You get it? That is the ratios. But when it comes to here, ROCE or the ARR or the AARR is different. So we look at average returns, average profits, and then divided by average investment. So typically you get an initial investment and there's a residual value. You add the two, you divide by 2. That's it. And then divide by the average profits. Okay, so you get profits for 5 years, add them, find the average of that 5-year profits, divide it by what? The average investment. Average investment here is the initial investment plus residual value, if there is any, divided by 2. Okay, that's it. All right, let's move on. So like I said, a capital investment decision could be putting up a land or building, or some typically improving a major part of an infrastructure. Okay, putting in place some computer infrastructure, digital infrastructure, computing system, even AI, cloud-based system automation could also be capital intensive. Even the branding, like I said, so you could see Apple, McDonald's, the branding, setting up a franchise is significant. Procuring vehicles, plants and machinery, fixtures, expanding your business into other territories, launching a new product, these are all part of capital investment decisions. Okay. So we want to look at these decisions, and like I said, these are the techniques we'll be looking at. So the first two are the non-discounted cash flow methods, whereas the last two are the discounted cash flow methods. Okay. The internal rate of return is simply saying that it is a brother. I always say it is a brother of NPV, because you have to work an NPV, two NPVs, before you plug it into a formula, a very simple formula to arrive at your internal rate of return. Okay, let's look at this in practice. So organizations want to make decisions when they want to take such significant infrastructure or projects in the future. So why? Because it requires large outlay of funds, and the outcomes may be uncertain. So you have to go through some probability analysis, some simulation analysis, some sensitivity analysis before you make such decisions. Okay. Now, critical features of this capital budgeting or capital investment decisions are that it helps the entity to achieve its long-term strategic objectives. Okay. Now, the benefits may not just be limited to 1 year; it spans over several years, 5 years, 6 years, 7 years. Okay. So you cannot tell me that the capital investment appraisal, which is more strategic oriented, long-term oriented, is just for 2 years. Some people might think yes, but that would normally be a medium term, short to medium term. But when we talk of a capital investment decision, it should span over 4, 5 years, 10 years, right? Now it will involve, like I said, a huge amount of funds we need to invest. And the accurate prediction of these benefits is difficult. So it deals with some uncertainties, and probability plays a key role there. There is always an opportunity cost, okay? Why would I put up a building, or why would I expand this business in another territory, whereas I could have used that money or invested that money in the stocks or in the shares? Okay, so with a capital budgeting or capital investment decision, it typically deals with making a decision and taking control. The idea is that here you want your programs and projects to span over multiple years. And so the reason why I will not put money here or in the savings in the stocks is because I feel that when I invest in this project, expand this project, I can manage it well. I can control it well, and I'll make enough revenue. Okay, so there is always an opportunity cost. I mean, it's a benefit you forego so that you gain another benefit. That's what is happening here. There's always this notion you would have heard: the higher the risk, the higher the return. Isn't it? It's true. So most of the rich guys today undertake high risky projects, and they undertake this kind of analysis, capital investment decisions before they launch such projects. So if we invest the cash in the project, we can't invest it in another place. So you see that projects will be mutually exclusive. Buy land or put up land and buildings. Expand your go and buy a vehicle or launch a new project. Mutually exclusive. They are not the same. They are not the same. So what happens here is that you may not be able to have so much money to take care of all of this. So you ration your capital rationing. So when I cannot have enough money to invest in both projects, I need to take this analysis and invest in the one which gives me the highest return. Okay. In the news, look at some examples, typical example. So Delta invests 50 million in its RFID baggage tracking technology. That's IT, right? That's computing, but it is capital intensive. Apple-based tableside tablets to bring interactivity to dining. So Applebee will add 100,000 table-side tablets to over 1,800 US outlets, demonstrating the potential for transforming restaurant dining into an interactive experience. And this requires investment analysis or decisions to be taken. So in capital investment intensive, you could think of more. You could think of more examples. Okay, look at this one also. The impressive technology behind Sasol's new R2 billion to 2 billion head offices in Santon, right? Should you buy or rent a cable modem? Some more analysis comes in there, right? Okay, so it happens almost everywhere. Another one, we look at Roehampton University opening its library, which cost them £35 million. That's capital intensive. Capital intensive, right? All right. So they got a state-of-the-art library on 4th September, sometime 2017. That's what was reported. And this deals with so much investment analysis which went in. All right, let's look at the techniques. Payback period, what does it mean? It simply says, how many years will it take you to pay me back? If I invest 10 million today, how many years will it take you to pay me back? That's all. Average accounting rate of return. So the payback is reported in years, in time, period. Okay. Average accounting rate of return is simply percentage. The higher, the better. The payback period, the lower, the better. If the project pays me back earlier, that's good. But if it takes a long time to pay me back, it's not good. If the accounting rate of return is higher, that's good. It's like a profitability index, right? It's like a profitability ratio, okay? Net present value is measured in monetary terms. If you get a positive figure, go on with the project. If you get a negative, don't go on with the project. If you have two projects and they're all giving you positive, and you have the money, do both projects. If you don't have the money, choose the one with the highest positive NPV. If both are giving you negative, don't tell me that, oh, well, project A gave me a lower negative, project B gave me a higher negative, so I'm going to go for the one with the lower negative. No, you don't work to make losses. If they are negative, don't do it. Internal rate of return is a percentage. It is reported in percentage terms. It simply tells you that at what percentage or discount rate or interest rate, let me put that way, at what interest rate would your project give you zero NPV? Zero. It is a trial and error method. It's not actually accurate. Okay, payback, let's start. So like I said, it takes the number of time for the initial investment to be repaid out in terms of cash flow, right? So we'll take an initial example. So let us say that the initial outflow is 60,000, and then there's annual cash inflows of 20,000 for 5 years. So in year one, initial year we normally say is year zero. So in year zero, I invested 60,000. Year one, I got 20. It's left with 40,000. In year two, I got another 20. It's left with 20,000. In year three, I got another 20. So in year three, it paid off. It paid off totally. Forget about year four, it still gives you 20. Year five, it gives you 20. Payback period doesn't care about the cash flows that comes after it has paid you back. So you can see that it paid it back exactly 3 years. Exactly 3 years. Okay, there could be a little bit of, I don't want to say calculations or complications, but we are just taking the basics, okay? We'll take the basics. So the shorter, the better. If you have mutually exclusive projects, different projects, take the one which paid you back quickly. So let's take now this example. So we've got projects A, B, and C. Initial investment for project A is 18,000, B is 9,000, C is 15,000. These are the cash flows that come through. Let us work it out and see. So how long will it take to pay me back project A, project B, and project C? One step at a time. So look at project C. We're dealing with project C, the 15,000. So I'll go one step back. Project C, we're dealing with project C, okay? Let's go through the whole question. Let's go through it again. All projects have some initial investment cost. The projected cash flow for the 3 investment options are also provided. Suppose the company's maximum acceptable payback period is 2 years. Which project should the manager select? So we're saying that if this project pays you more than 2 years, guy, don't go for it. Ignore it. But if you take project A, 18,000, year one, it paid 9,000. Knock off 9,000 from 18,000, left with 9,000. Year two, another 9,000. So project A actually pays you back in 2 years. Right. What about project B? 9,000. First year, 4,000, left with 5,000. Second year, 2,000. Left with 3,000. So this one will pay you back in 3 years. So if you want me to choose between A and B, I'll go for A because A paid me within the 2 years threshold, whereas B paid me 3 years exactly. What about C? That's what we're going to look at. Okay, there's a 9,000, there's a 8,000, there's another 9,000. Let's work it out. So the cumulative cash flow for the initial year, which is year 0, is 15,000. That is a negative. We invested. It's an outflow. That's why it's negative. All right. And then year 1, there is a 9,000. Reduce the 15,000 by the positive 9,000, we get 6,000. But in year 2, we had 8,000. The 8,000 will knock off the negative 6,000 and to be left with a positive 2,000. So it tells you that this project paid you not in of course not year 0, but not in year 1, but when it was moving from year 1 to year 2, it paid you off. So how do you do it? So it is 1 year. So that year 1, it is 1 year. Now calculate the months. How do you get the months? That 8,000 versus that 6,000. Ignore the negative sign. Take the absolute figures. So it is that 6,000 negative figure which changed to become positive. That negative figure which changed to become positive because of that 8,000 positive effect. So that negative 6,000 divided by the cash flow. So it is a cumulative, that negative, the last cumulative cash flow, negative cumulative cash flow, divided by that positive cash flow. Ignore the negative, ignore the positive, use the absolute, multiply by 12. That's all. So that's why I see the 6,000 divided by 8,000 times 12, it gives you 9 months. So this one paid us back 1 year, 9 months. Project A paid us in 2 years. Project B paid us in 3 years. Project C paid us 1 year, 9 months. Which one do you go for? You go for the 1 year, 9 months. Because it paid us quickly, right? It paid us quickly. But although the analysis, the narratives over here are what I have just explained. When you get a rounded figure, 9.2 months, make it 9 months. 9.5 months, round it up to 10 months. Okay. 9.7 months, make it 10 months. All right, that's it. So typically, this is what I said. Project A will pay us back in 2 years. B will pay us back in 3 years. And C will pay us back in 1 year, 9 months. C has the lowest payback period. Go for it. Go for it. If you have too much money, you can go for project A as well. But ignore B because it is above that threshold. Average accounting rate of return or accounting rate of return, also called a return on capital employed. So it's an accounting measure where we have the income divided by an accounting measure of investment. It's also called a return on investment, return on capital employed. Okay, so and sometimes some will even equate it to return on shareholders fund. It's interesting. Yeah, among like what decision do we go for? If you have more than one project, choose the one with the highest ARR. Okay. All right, so ROC serves as a good benchmark on ARR for the industry. So this is a formula: average annual profit before interest and tax divided by initial capital employed. Divided by the initial capital employed. All right, so let's do with the calculation. Here it is accounting. So look out for any accounting expenses and take them out. Depreciation normally plays a key role here. So we're not dealing with monetary, we're dealing with accounting policy estimates, okay, numbers. So here, calculate the depreciation for the investment for each period, and depreciation is simply the measure of the consumption or wearing out of a fixed asset or a non-current asset through use of obsolescence or the passage of time. So the benefit, you reduce profits to accommodate the initial cost of setting up the business, and you spread the cost over the useful life of the asset. In that case, you may just want to, some people set aside money. So they calculate the depreciation, they set aside money. So you may want to say, let me use this money I have set aside to buy back this, to buy a replacement asset later on. Okay. We want to use the straight line method. So we've got a reducing balance method. We've got the sum of the years decade, but the straight line method. So where we've got the initial cost of the asset minus any residual value or scrap value divided by the useful life of the asset, estimated useful life of the asset. Let's try one example. Same projects, okay, same 3 projects, A, B, and C, same cash inflow. So here, equate the cash inflows to be profits. Equate the cash inflows to be profits, okay? All right. Now let's go and work this one out. We're going to use the straight line method, okay? Now they said 3 investment. They all have some initial cost expected to incur at the start. So the figures there are profits before depreciation for the 3 months. So we're going to calculate depreciation and deduct them from these cash flows, these figures, right? And then they say determine the ARR for each project and comment which one should we select. Adjust the operating profit for depreciation using straight line, and the historical ROC is 20%. Which of the 3 projects are viable? So we want to assume that they all have 3 years useful life. And we assume that when we sell them, we'll get nothing. So 0 residual value, right? So go on and calculate. What is the average profit? So the depreciation, let me go one step back. The cost of asset A is 18,000. It has 3 years useful life. So divide the 18,000 by 3. It means depreciation is 6,000 each year. When it comes to project B, 9,000. Useful life 3 years. So it means each year depreciation is 3,000. 15,000 project C. Useful life 3 years. So depreciation is 5,000. So what do you do with 18,000? Depreciation is what? 6,000. That's it here. These are the figures here. So for each profit, subtract the depreciation, you get a net profit here. These are the profit before tax and interest. The interest, we mean interest on loans. All right. So at the end of the day, add these figures, 2,000 to 6,000 to 2,000, which is what? 10,000. And find the average of it. So 10,000 divided by 3 is a 3,333 divided by the initial investment. There's no residual value, so don't worry your head. That's it, and express it as a percentage. So you get what? 18.52. What is the ROC? 20%. The benchmark to check whether we should go for it for the industry is 20%. For project A, we got 18%. It's below. It's below standard. It's below the benchmark. I wouldn't go for it. Let's go for project B. Like I said, it is 9,000 initial costs over 3 years. So depreciation is 3,000. These are the cash flows. Subtract the depreciation, you get 2,000 each. 6,000 divided by 3 is 2,000. That's the average. Divided by initial cost, which is 9,000. You got 22%, which is higher than the ROCE benchmark of 20%. So it's good news, right? Do for the project C as well. Depreciation 5,000 each. Subtract them from the profit before depreciation. You get these figures. Sum them up, get 11,000. Divide by 3, you get 3,667. Divided by the initial investment of 15,000, you get 24.4. In this case, we see that project C is still reporting a higher rate of return. So you go for it. You go for it. In the first one, we said what? Go for project C again because it was around 1 year and 9 months. Again, here project C is giving us a higher figure. So you can still go for it. All right. If you got some money, yes, of course, you can go for project B because that one is also higher than the benchmark. But if not, you can just go for project C. But project A should be totally ignored because it is below the benchmark. Then we come to the almighty NPV. Lovely topic. So we want to calculate the expected net monetary gain or loss from the project by discounting all expected future cash inflows and outflows to the present value. So when we say discounting, it's simply saying you are reducing a future price, a future amount to a lower figure today. So the future figure is higher. reduce it to a present figure today. So you go to the shop to buy a dress and they tell you 50% discount. What are they saying? They say buy it now and get a 50% reduction. If you don't buy it now and you come tomorrow, the price may have changed or they would have taken off the discount. The same thing is here. So discounting is more reducing a future figure, a future higher figure to a lower figure today. Okay, decision rule, like I said, accept all positive NPVs. Accept all positive NPVs. Among any competing projects, go for the one with a higher positive NPV. Never go for a lower NPV, okay? So there's a discount factor we use, which you can see the formula here. So the present value formula, where is future value divided by 1 plus the rate to the power n, or the number of times. That's a time value of money. So the discounting helps you to get the time value of money. But usually, what happens is that you get these discount tables, okay? So you don't really worry your head much. So what are we saying here? I just want to take a simple analysis here. So let's say you've got some money, 100,000 you invest. If you invest it over 4 years at a rate of 10%, on condition that you will not go for your interest every year. So each year you get an interest, you add it to the principal and you say reinvest, and then 10% over time. You end up getting 146,410 after 4 years. Don't go and withdraw your interest. But working this a long process, you can simply use the present value formula or the future value formula. Okay. All right. So if you want to get a figure, the future figure, let's say by applying this equation, you can observe that 121,000 received at the end of year 2. Here, this one. If you want to discount this or reduce this to a present value, how do you do it? You use the present value formula. So it is simply what? The future value divided by 1 plus the rate. That's all. If you take for year 2, that's 121,000 divided by 1 plus the 10% to the power 2. That is a year. You can also work this whole long process here in one simple step by using the future value formula. Future value is simply present value times 1 plus the rate to the power n. So this figure is here. This 1 plus r to the power n multiplied by the present value. That's it. And you get a future value. If you like, it's just a change of subject. Make future value the subject, and that's it. You will still get this figure. Okay. Pretty easy. So that's the present value. So we discount future cash flows to their present value, after which we subtract the initial investment. That's all. Very easy. Okay. All right. So these are step-by-step procedures you may follow. Identify all relevant cash flows and both inflows and outflows. Select an appropriate rate of interest, what we call the discount factor or cost of capital or weighted average cost of capital, discount rate. Okay. Identify the correct discount factors to choose per the rate, and then multiply the annual cash flows by the appropriate discount factor which you would have computed. Okay. And then determine the present value figures to determine, sum up the present value figures to determine the present value and subtract the initial outlay. Let's take an example. So these are discount factor tables. It's always given. So if you are taking 4% for 4 years, the discount factor is what? 0.855. So you multiply this by the future cash flow you will get in 4 years. If you're going to take 8% here over 5 years, that is 0.681. So if in 5 years you're going to get 500,000, multiply that 500,000 by 0.681. It will reduce it to a lower figure. So you always get this discount value, present value discount table or factor tables. You get it. Be careful. There are 2 tables. We've got the annuity table and we've got the lump sum. What we are dealing with here is a lump sum. Lump sum means you invest the money one lump sum over a period. That's all. Annuity means you invest every month, every year, the same amount, the same fixed amount in installments. Okay. That's not what we're dealing with. We're dealing with a lump sum. Let's take a simple example. Let's say the discount factor is 10%. So you can always get your 10% here. This 10%, And the rates, the figures are here: 0.909, 0.826, 0.751, okay, so on and so forth. And then we are told each want to buy 2 machines, and they will last for 4 years, for 3 years. We're going to use them for 3 years. And these are the cash flows we will get. The year 0 is immediately, now, currently, today. How much would we pay? That's year 0. So we pay 10,000. That's the outlay. And then we've got the 75,000 for machine B. These are the cash flows we will get. 10% discount. What do we do? So reduce for project A, reduce their 5,000 and see what you get. So you discount each one by the 10%. You discount each one. We are working it this way, but you can simply say 5,000 here times the discount factor, which is here, 0.909. The next one, multiply by 0.826. The next one, multiply by 0.751, right? These ones. So you could divide through, get a discount rate, or just multiply it. Easy. Okay, and then subtract the initial outlay. Do the same for project B and see what you get. So this is what I'm talking about. So these are the discount factors given. The discount factor for every year 0. Any number raised to the power 0 is what? 1. So for year 0, you always get 1. And then these are the discount factors from the table, or you can compute it. If you like, getting 0.909 is simply 1 divided by 1 plus 0.10 to the power 1. That's all. So you find the discount factor or use the table. When we multiply the figures, the cash flows with the discount factors, we get this. So you can see, we are saying that 5,000 that we'll get in a year's time, today is actually 4,545. We thought we'll get 4,000 in 3 years' time. It is actually, this figure is not too right. It's about 3,004.5. You get it? Okay. Then you sum all of them up. So you sum these positive figures up. Okay. So let's work this one again. So you would realize that this figure, I think the slide is missed off a little. So sorry for that H. So this 4,000, let's go 4,000 times 0.751 should give us, yes, 3,004, not 30,045. So 3,004. Ignore this 5 here. Now you sum these positives and you subtract the negative and you get a positive NPV. Positive NPV. That's good news. Do same for machine B and you get another positive. The reality is that machine B is giving us a higher positive of 2,740 monetary terms compared to machine 1, which is 855. So go for machine B because it gives us a better option, right? Okay, so that's what we're talking about. So again, the same H was created here. It should be 3,004, not 3,000. Ignore this 5. Okay. All right. So machine B is the best option to go for. Internal rate of return says that we have the initial percentage. We have the initial percentage or discount rate, the hurdle rate. Choose another rate. Or you may be given another rate. And then they ask you to compute another NPV and slot it into a formula. Okay. So it is the discount rate at which the present value of the expected cash inflows from a project equals the present value of expected cash outflows of the project. So it's like break even. It's like breaking even. So your NPV is 0. That's all. What is the decision rule? When your IRR is higher than the initial cost of capital or discount factor, go for it. Go for it. Okay. So compare it to the cost of capital. That's all. So if your IRR is higher than the cost of capital, which is given in the question, go for the project. If you've got 2 projects and one is given a higher internal rate of return, go for that one. Okay. So this is a formula I'm talking about. So you've got an IRR. Okay. So I would normally say IRR is equal to smaller rate. The R plus is the smaller rate plus the NPV of the smaller rate divided by the NPV of the smaller rate minus NPV of the bigger rate. Bigger rate. Why? Because it's a simple analysis. It's a simple analysis. Let's say the rate is the same as the interest rate. If I borrow 10,000 and I'm paying 10%, and you also borrow 10,000 and you are paying 20%, who will lose? You will lose. You are going to lose. So the higher the rate, the lower the returns. But the lower the rate, the higher the returns. So if you use 10% to calculate an NPV and you get a positive NPV, and you're going to use 20% to calculate the same NPV, you're going to get a negative or a lower NPV. All right, that's it. Okay, so the R plus is the smaller rate. It will give you a positive NPV. The R minus is the bigger rate. It will give you a negative NPV or a lower NPV. And anytime you get these calculations, try and make sure that, but that's why I said it's a trial and error method. Make sure you get one positive NPV and one negative NPV. Then the calculation will be easy for you, all right? Okay, so then you slot it into this. And then, like I said, you multiply by the bigger rate minus the smaller rate. You don't end up getting a negative rate. Be careful. Don't get a negative rate, all right? So I think that's it. We ended there. So this is a decision rule for average accounting rate of return. You'll be given a benchmark, okay, compared to the benchmark. If you are higher, go for it. If your ARR is higher, go for it. If there are competing projects, choose the one with the highest ARR. Payback period, choose the one which has a shorter payback period. If there are two or more competing projects, go for the one with the shortest payback period. NPV, choose a project which is positive. Don't go for a negative. If there are two or more competing projects, go for the one which has the highest positive NPV. Never go for a negative, no matter what. Internal rate of return, for any project to be selected, it must meet the IRR requirement, that is opportunity cost. Compare it to the cost of capital or the discount rate. If it is higher than the discount rate, go for it. If there are competing projects, go for the one with the highest. All right, which methods is to be preferred? It depends. It depends. So what project should be undertaken, but also what project could be undertaken is what you should look at. So capital rationing comes in, you don't have all the money. You may want to choose the one which gives you the maximum benefits. Don't only consider the numbers. Consider other qualitative factors. Will employees be satisfied with the new project? Are you not going to harm the environment? What about the governance structure? Will it help achieve your objectives? Will it impede any aspect of diversity and inclusion? Do you have the technical know-how to run the project? Consider other non-financial factors, okay? So the effect of performance measurement on capital investment decision is such that excessive focus on short-term profitability in evaluating performance can have a negative impact on the longer-term profitability. So avoid projects which have a favorable impact in the long term to ensure short-term. That is, avoiding projects that have a favorable impact in the long term to ensure short-term profitability. Some people want quick money today and they forget the future. Remember, profitability normally measures longer-term survival of the company, whereas cash measures the shorter-term survival of the company. We end here. And then, like I've said, this is a very good topic. We've gone through most of the dimensions, okay? We didn't do a calculation on the internal rate of return, but it's a simple trial and error. You know the NPV method, just choose another rate. So this is what I would do. If I use 10% and my NPV gave me 855, I'm going to use a higher rate to calculate the internal rate of return. So I'll go and use maybe 15 or 20%. Trust me, your 855 will reduce, becomes negative. But if I had used, let's say, 20% and I got a negative NPV, that's my first calculation. To calculate the NPV, the IRR, what I'll do is that I'm going to choose a lower rate so that I get a positive. So always try and get one positive NPV and one negative NPV. Slot them into that formula. Life goes on. Very easy. All right. Okay, I'll leave it here. You'll be fine. Like I said, there are other methods like the Profitability index, we didn't look at that. There's also a discounted cash flow methods. Discounted payback method. Okay, you could try those ones. I'll leave you here and I'll catch you up when I catch you up. All right, take care and bye for now.